Welcome to The Explainer. I am so thrilled you're here. Today, we're unpacking what is arguably the most massive macroeconomic event of our entire generation, the historic June 12, 2026 SpaceX public offering. Trading under the ticker SPCX, this really wasn't just another tech company going public. It was a structural earthquake in the global capital markets that absolutely rewrote the rules of technology valuations.
So, we're going to peel back the onion on this complex, multi-layered financial paradox step by step. We'll be looking at 1. The trillion-dollar debut. 2. Engineering the artificial squeeze. 3. The great valuation schism. 4. Starlink profits versus AI burn. And finally, 5. The Musk volatility factor. Let's dive right in.
Starting things off with Part 1, the trillion-dollar debut.
Just to anchor us right out of the gate here, the sheer unprecedented scale of this liquidity event is mind-blowing. The initial post-money enterprise valuation hit a staggering $1.77 trillion, but it didn't even stop there. In the trading days that immediately followed, aggressive accumulation pushed that valuation soaring past the $2.64 trillion mark. In doing so, SpaceX casually bypassed corporate stalwarts like Amazon to become the fifth most valuable public company on the planet.
To really put that macro impact into perspective, consider this. SpaceX alone raised $75 billion in primary capital. Now, if we look back at the entire United States IPO market for the previous year, all of 2025, that entire year, across more than 1,300 distinct deals, raised $170 billion. So SpaceX effectively vacuumed up nearly half a year's worth of typical market liquidity in just one single massive transaction.
Which leads us to ask, how did the price get pushed up so violently? That brings us to Part 2, engineering the artificial squeeze.
The underwriters essentially orchestrated a massive supply and demand mismatch. They deliberately restricted the initial float to a tiny 3 to 4.9% of total equity. And then, literally, just hours before the debut, they slashed the retail allocation from 30% down to 20%. This created an intense perceived scarcity. Retail investors were so desperate for a piece of the action that they completely flooded the derivatives market. This resulted in an algorithmic gamma squeeze fueled by a record-shattering 1.8 million options contracts traded in a single session.
But honestly, the real fuel to the fire was institutional. NASDAQ implemented a pretty controversial fast-track rule, ensuring SpaceX's inclusion in the NASDAQ 100 within just 15 trading days. That specific maneuver forced $22 to $27 billion in blind, passive ETF buying. Meanwhile, the S&P 500 actually strictly rejected SpaceX based on its GAAP profitability requirements. So the massive takeaway here? It's the illusion of choice. Passive index investors tracking the NASDAQ were suddenly forced into this idiosyncratic, highly volatile stock entirely without the mechanism of active choice.
And when we look at the timeline, this all builds into what analysts are calling a max Q event. If you know aerospace, max Q is the point of maximum aerodynamic stress. For SpaceX equity, that stress comes from a series of staggered lockup expirations. Phase 1 kicks off shortly after earnings, unlocking $120 billion in shares. That cascades through the autumn in Phase 2, leading into a massive $1 trillion broad release in December for Phase 3. And finally, it culminates in a monumental $2 trillion founder unlock in the summer of 2027. We are talking about an impending massive wave of supply just waiting to dump onto the market.
All this supply and demand chaos brings us right to Part 3, the great valuation schism.
So I really want to ask you directly, what is SpaceX actually worth? Seriously, how do we fundamentally price a hybrid entity that is part aerospace infrastructure, part telecommunications monopoly, and part deeply unprofitable artificial intelligence startup? It completely defies traditional metrics. And because of that, the experts are fiercely divided. On one end, Morningstar gives a highly conservative fair value of $780 billion. Then you have Aswath Damodaran, the dean of valuation, sitting in the middle at $1.3 trillion. And way over on the other side, institutional bulls like New Street Research are setting targets at $2.3 trillion. But here's the catch. To justify New Street's target, you literally have to throw out standard models and use a massive 20 to 25-year projection horizon, assuming SpaceX secures an unbreakable, permanent global monopoly on low Earth orbit.
Let's actually zoom in on Morningstar's strict institutional warning for a second. They price the equity at roughly a 60% premium to fundamental fair value, pinning it strictly at $63 a share. By clinically isolating the sum of the parts, they value the core space and Starlink business at $40 a share.
Then they add $16.50 for a probability-weighted AI option. And this is key. They assign a net present value of exactly 0 to long-tail narratives like Mars colonization.
And how do they get to that $16.50 AI option? Well, Morningstar gives a 43% chance to a no-go scenario, meaning there's a nearly coin-flip chance the entire orbital AI vision failed due to physical constraints, which would incinerate $81 billion in capital. Conversely, they see only a tiny 7% chance of the moonshot scenario, where SpaceX actually succeeds in deploying a massive 11.6 gigawatt orbital cluster.
That orbital AI cluster is a huge variable, which flows right into Part 4, Starlink profits versus AI burn.
The crucial point here, laid bare by the S1 filing, is this stark operational paradox. SpaceX operates Starlink, which is an incredibly profitable telecommunications business, boasting a 39% operating margin and generating $4.4 billion in income. But they are taking all of that cash flow and using it to heavily subsidize xAI, the deeply unprofitable AI startup they absorbed. And xAI posted a massive $6.35 billion operating loss, the result of all this internal subsidization, a consolidated net loss of nearly $5 billion for the entire enterprise.
To fund this massive AI ambition, particularly the Colossus supercomputer down in Memphis, SpaceX has actually had to become a terrestrial landlord. And there is a deep, deep irony here. SpaceX's in-house AI model, Grok, fundamentally lacks the capability to fully utilize their own massive hardware setup. So, as industry analysts pointed out, SpaceX is now supplying the highly lucrative picks and shovels to industry leaders, simply because its own mining efforts have stalled.
And let me tell you, those picks and shovels are not cheap. SpaceX is renting capacity to Anthropic for over $1.2 billion a month, and to Google for $920 million a month. But here is the most fascinating part of this circular capital flow. Google is actually a 7% equity owner in SpaceX, so Google is effectively paying for its own investment. They drive revenue directly to SpaceX, which in turn just boosts the value of Google's own equity stake.
But SpaceX didn't stop at hardware. To bridge their software gap, they elegantly went out and bought Anysphere, the maker of the globally dominant AI coding tool Cursor, for $60 billion. The financial masterstroke here, they executed this as an all-stock acquisition right after their IPO rally. Because their unseasoned equity was trading at a highly inflated 141 price-to-sales ratio, they were able to buy a generation-defining asset while diluting their existing shareholders by a mere 3.4%. Absolutely wild.
But even with brilliant financial engineering, there is one major qualitative variable that overrides everything else, and that is Part 5, the Musk volatility factor. You just can't run a standard quantitative DCF model without acknowledging corporate governance here. CEO Elon Musk commands an estimated 40 to 50% economic stake in the firm, but far more importantly, he holds supreme, totally unassailable voting control over the board of directors.
Remember Aswath Damodaran, the valuation expert we mentioned earlier? He explicitly flags this exact concentration of power, warning that the company operates entirely without institutional guardrails. For you, the focused learner, this is vital context to grasp. Those passive index investors we talked about, the ones forced into this stock, they are suddenly subjected to a governance model that functions a lot more like an absolute monarchy than a standard publicly traded tech firm.
And naturally, this governance structure breeds immense volatility. Historical data from PitchBook models what they call the Musk effect, showing that his public persona, political maneuvers, and strategic pivots independently trigger 12% price swings. Plus, institutional markets actually apply a credibility ledger to his ambitious timelines, systematically discounting them by a factor of 1.5 to 2.5 times. And because SpaceX operates on that incredibly thin 3 to 4% float we talked about, analysts estimate all this volatility will be drastically amplified. We're talking wild 20 to 30% price swings based purely on geopolitical sentiment and public maneuvers.
But beyond all the sentiment, beyond the governance, we have to ground this entire multi-trillion-dollar valuation back in physical reality. All the financial engineering in the world literally doesn't matter if the rockets don't fly. The fundamental premise of this valuation requires achieving an 85% reusability rate and executing 340 Starship missions annually by the year 2035. Any systemic engineering failure, regulatory grounding, or exploding rockets will utterly break the company's discounted cash flow models.
Which leaves us with this final, truly pivotal thought to take away today.
As this company faces a looming avalanche of insider stock unlocks and attempts to build an completely unproven orbital AI network, we have to wonder, in this monumental collision of market hype and financial engineering, will the fundamental laws of physics ultimately accommodate the boundless economic ambitions required to support a multi-trillion-dollar valuation? That, my friends, is the trillion-dollar question. Thank you so much for joining me on this explainer. Keep learning and keep asking the big questions.